Hi, I'm Trevor Austin, founder of Authentic Life Financial Planning. In this video, we're diving into RSUs 101. Before we jump into the video from my recent webinar, I do want to share one thought that didn't end up making it into the video, which is how I like to think about RSUs. RSUs are essentially a bonus where the value is tied to the company stock price, and when the shares eventually vest, you go out and purchase the stock with the bonus. That's essentially how it is taxed. That's essentially how it operates from the vesting standpoint and from the value standpoint. It's essentially a bonus that is paid out in company stock. I think that's a really good way of thinking about it because it takes this kind of complex unknown thing, which is the RSUs, and makes it into something that is easier to understand. Let's take a look at restricted stock and how it operates, what the life cycle really is. There's three main things that happen with restricted stock. The first thing is it gets granted, and then eventually it vests, and finally it is sold at some point. Now at grant, there's three things that essentially happen, three things that the employer receives at that time. The first is the equity plan itself. So you'll receive the information that has all the details that you could possibly want to know about how your company's equity plan operates. It'll give you all the key information and probably more information than you need, but it does have some important points within that document. The second thing that you'll receive is the grant award itself. That'll tell you how many shares you've been granted. It also will include the vesting schedule. Companies generally have a standard vesting schedule that they use, but individual awards can be set up on different vesting schedules. Companies get to do what they want, so they can choose the schedule that makes sense for them. And so even though you receive all that information and the shares are officially granted to you at the grant, nothing's really happened from a tax perspective. Nothing's really happened from a cash flow perspective. You don't own the shares at that point. You've just merely been granted them. They exist. As long as you stay at the company and meet the vesting requirements, they'll become yours. But at grant, nothing really has happened yet. Once the shares have vested, now they have become yours, or at least part of them have become yours. And so at that time, you receive the shares. The value is included in taxes for that year. And some shares are usually sold to pay the tax withholding. That's not always the case, especially with private companies. That's probably not going to be the case. But with public companies, that will be what happens. And we'll talk about the tax in just a little bit here. And then in the future, or even on the day they vest, eventually those shares are sold. And what happens then, you receive the proceeds after any transaction costs and taxes that are being withheld, and you receive the cash after all that stuff. I do want to clarify one thing. I should said taxes withheld. That's not generally going to happen with a sale. Generally at that point, you have to figure out what you will owe in taxes. And it may be, if you sell when the shares vest, it may be enough withholding, it may not be. In a couple weeks here, I'm going to have another webinar talking about tax filing when it comes to equity compensation. And I'll talk through more of the issues that can come up in that call. So let's look at restricted stock taxation. So as I said before, at grant, nothing really happens at that point. Again, there's no tax owed, the shares aren't yours. You've merely just been granted the stock award, and that's it. What happens at vest then, that is where the bulk of the taxation really is going to come into play. And so at that time, the shares vest. The value of the shares is included in your taxable income for the year. It's generally going to be taxed as compensation income, which means federal taxes apply, state taxes apply, local taxes may apply, Social Security taxes apply, and Medicare taxes apply. So 5 different taxes likely will apply when your restricted stock vests, which means you have to have a plan for that. Some of it, like Social Security and FICA, will come out automatically as part of the withholding. Fed, state, and local taxes will also be withheld, but they may not withhold enough. Again, having a webinar in a couple weeks here to discuss that more. Once the shares have been sold, then another tax comes into play, which is capital gains tax. Capital gains tax is separate from compensation income. Short-term gains get taxed at the same rates, but FICA, so Social Security and Medicare, does not apply in that case. But federal taxes still apply, state taxes still apply, and local taxes may still apply. When it comes to long-term capital gains, those are preferential rates, which means they're lower than the ordinary income tax rates that you pay on salary, bonus, restricted stock vest. And so the goal is to have your capital gains, if you're going to have capital gains, be taxed as long-term capital gains. But that doesn't mean that you should hold your shares until then. And the reason I say that is because when it comes to this part of the tax that happens at sale, the only thing that is getting taxed is the difference between the price when the shares vested and the price when they're sold. So if the price has risen since the shares have vested, that difference is what is being taxed as a capital gain. And it could be a short-term gain, which is 1 year and a day, 1 year or less, or it can be long-term, which is 1 year and 1 day or more, then it's a long-term capital gain. So just because it's better to have a long-term capital gain does not mean that you should hold until then, because you have to wait a full year to sell those shares at long-term capital gains rates. So it may not be worth waiting that long to sell the stock at that time. So let's look at an example. So we have Will Be Rich, who works for our ABC company, which is a large tech company. He's worked there for a while now, so he's received grants over the last couple of years, and he has just received his grant for 2025. And so for his grant, he has a target of $50,000 that his company is granting him. The current fair market value as of today is $100. And so they're going to grant him 500 shares because they're targeting this 50,000. That's how much they want him to receive. For his vesting schedule, 25% vests after 1 year, and then the remaining shares vest quarterly over the remaining 4 years. So it's a full 4 years with a first portion vesting on March 4th, 2026. So that's 25% of the grant. And then the remaining shares vest quarterly until March 2029. So it's 4 years total with 25% vesting after 1 year. And then if I'm doing the math correctly, 6.25% vesting after that each quarter. Now, to continue that example, let's see what happens when the stock hits its first vesting date. So it's all the same information, same target, same fair market value, same shares. But now it's March 4th, 2026, and those first 125 shares have vested. The current fair market value is $120 per share. And so the question then is, how much, what to him on March 4th, 2026, how much is vesting as a dollar amount rather than a share amount, and how much is being included in ordinary income. And so with this example, the calculation for that is just fair market value times the number of shares vesting equals the value to Will on that day. So for him, $15,000 will vest on that day. So that's the kind of the value of the shares that are vesting on March 4th, 2026. And that's how much is going to be included in his income tax calculations for the year, $15,000. So let's say instead of $120 as the fair market value, instead it's $80 per share. And I'm gonna do a quick poll because I think I have this one ready to go. So I'm gonna publish a poll. So hopefully you're able to see that. So the question is, how much ordinary income, or I should rephrase that, how much capital gain, or excuse me, compensation income will hit Will's 2026 tax return when those 125 shares vest and the fair market value is $80 per share. And as a reminder, it's just fair market value times the number of shares, which is 125 shares, will vest. All right, that's what's included in income for the year, excuse me. All right, I'm going to end the poll, and the number that I see is 0. So that's not true. It'd be $10,000. So with restricted stock, there, because it's just the pure value of the shares, it's just the fair market times the number of shares vesting. That's the income. That's the value that that will is March 4th, 2026. So in his case, even though the stock price has dropped by $20, there's still value to the shares, even though it's less than what it was when he was granted those shares. So he still gets $10,000. $10,000 is still included in his taxes for the year. But yeah, there at least some value to him at that point. Thanks for watching. If you found this video helpful, please like, subscribe, and drop a comment below with any questions or topics that you would like to see covered. Financial planning is all about creating the life you want. Let's build it together.